Today we are going to see about licensing and registration of financial institution. In the last class, we have started the class with what is financial institutions and their key functions and importance. Before that, we have discussed something about the financial system, and I have explained you all that there are 4 components in the financial system generally. The first one is financial institutions, and second one is financial markets, and third one is financial infrastructure services, and fourth one is financial regulators. And then we have studied about the mainly focus about the financial institution and their key function, and then why financial institutions should be managed and how it different from other institutions. I have mentioned you all that why a financial institution has to be considered as a special institution, because they are functioning or they are carrying out their business mainly sourced by depositors fund, the general public fund, rather than owners fund. So the financial institution has to have stringent regulatory policies and procedures. That is what the central bank and other regulators are there to implement the stringent policies and procedures. And then we have moved into the some areas related to the Companies Act to give some idea about how these financial institutions are incorporated and what are the roles and type of the finance companies and all. So in the first we have incorporation of companies we have seen, and under that we have seen the 3 type of companies: the limited companies and unlimited companies and companies limited by guarantees. And under the limited companies we have seen different categories. First one is the private companies, another one is the public company or listed public companies, and other companies, offshore companies and overseas companies and all. We have seen 3 or 4 categories under the limited liability company. And then we have seen about the article of association, and what are the aspects has to be included in the article of association, and related things have been seen. So there are 2-4 questions you will ask from me, and I have clarified. Actually, I like to further clarify those questions before starting the today's session. The first one is someone asked me the company's name. When I am discuss about the company's name, I have said that some wordings are restricted. One of the wording is Sri Lanka or state. Then one of the student asked a question from me. There are some companies, for example, Singa Sri Lanka, where it can be appeared in that way, or the word national had a national bank included. Actually, then I have gone through the Companies Act. There are some what can I say, some leeway or some exceptionals applicable for the company's name. The first one is, even though general restrictions are there, these general restrictions are there, with the approval of the particular minister in charge to the registrar of companies, they can include that that particular words into the company's name. But it does not mean that the particular minister can give approval to anybody. Actually, he has to think about that name is important for the national interest of the country. If the particular minister satisfies that, okay, this approving this name is good for a national interest of the company only, they can the particular minister can give the approval. That is one condition. Other one is these companies, our Companies Act, actually this clause has been included in the 1982, first time included in the 1982 Companies Act. Before the companies which are incorporated before, there may be 1 or 2 exceptions. So this clause is applicable, mainly applicable to the companies those who are incorporated after 1982. So now you can't open a company with that name. But there are some companies which which already incorporated before 1982 under the different acts. So those companies can have continue their name as it is. So that is about the company name. And somebody asked about the interest register. Actually, I have said the interest register is it's a register maintaining in the all companies has to maintain the interest register. But there are exceptions in the private companies. If all the shareholders anonymously pass a resolution, then they can avoid to maintain the interest register. So in that case, you may ask, one of the students asked that, what is the interest register? So in the Companies Act, it's clearly mentioned that the interest register is a register which record all the transactions between the company and particular directors or shareholders is called interest register. For example, one of the shareholder become as a director. In that case, the particular company gives some remuneration to the or salaries to the particular or salaries or allowance to the particular director. So that transaction is considered as a transaction between company and the particular shareholder. All those transactions has to be registered in the interest register. So if it is a limited public company, then they have to have the interest register has to be maintained. So if the exam or if in the exam or somebody asks you what is interest register, then you will have to be able to tell that this is a register which record all the information or all the transaction between a company and the particular shareholder. So all the public company has to maintain, but in the private company there is an exceptional clause where if all the shareholders anonymously pass a resolution, then they can avoid to maintain the interest register. And one more thing, somebody asked clarify about the overseas companies. And the overseas companies, of course, then they say that, okay, they can't have the businesses here in Sri Lanka. I explained you all that you all can't have the overseas companies cannot have the businesses in Sri Lanka. Then why these companies are getting registered? I say that for some tax purpose and all. Actually, on top of that, in the Companies Act, it says that if the companies, generally these companies for the non-profitable motivation companies, the companies which are functioning in Sri Lanka, but those functions will not generate any profit to the company, and those type of transaction would be they can carry out. So those these overseas companies are mainly open or registered in Sri Lanka for the purpose of some non-profitable activities, to carry out some non-profitable activities. And there are some other profitable activities also in exception, as an exception under the permission of the exchange controller, they can carry out, for example, mass media activities or the deep sea fishing and those type of things they can carry out. These are the things about the overseas companies. Okay, I have as per my remember, I just clarified all the things. If you have any question, you all can ask. Do you all have any questions about this related to the last classes? Then I'm free to answer, you can answer you can ask any questions. Actually, as I said already, if I know the answer, I will answer that in itself, or otherwise I'll just refer the things and answer you come with the answer in the next class. Again, I like to reiterate to you all that you can ask the question in two ways. One is unmute your microphone and you can directly ask the question. So through the chat box also you can send the message and asking your questions or clarify your any doubt. You can do that both one of the both ways. Anything you will have to clarify with me regarding the last class? Okay, since no questions are coming, I'm moving to the today's class. So you'll remember that we have stopped the class at this point, the shareholders of a company. And the shareholders in this section is again continuation of the Companies Act, and related to the what are the shareholders' powers and rights, what are the things they are having. So we will discuss that in this class, as well as we have seen something about the directors' rights and powers and their duties and all. We will look into that. After that, the shareholders' powers and duties, as well as directors' powers and duties, then we will move to the registration of financial institutions. So, so until that point, actually, these are the some aspect related to the Companies Act. So, a shareholder, who is a shareholder? That is the first question anybody can ask. If for example, if we start a question, if we start a topic, then somebody asks, what is that? So here we can ask, who is the shareholder? A person whose name is entered in the share register as the holder of one or more shares, he or she can be called as a shareholder of that particular company. So the simply say that if I buy a share, if I am having a share or bought a share of a particular company, then I become the shareholder of that particular company. But here is a particularly mentioned that my name has to be entered in the share register. Okay. In that case, somebody can ask that, okay, my name has not been registered yet. In that circumstances, whether I will be considered as a shareholder. Okay, there's some exceptional where the name has not been entered, still the name has not been entered in the share register, but he or she can be considered as a shareholder. That's what it says, that what are the circumstances. First one is a person named as a shareholder in the application of the company at the time of registration of the company. Okay, let's assume now we are going to register the company, or we are going to form a company, new company. At that time, there is no shareholder register, because once they incorporated only, they will start to maintain the shareholder register and all. So at that circumstances, a person named as a shareholder in the application of the company at the time of registration of the a company, in that case also, even though the name is not appeared in the share register, he or she can be considered as a shareholder. That is the first one. The second one is a person who is entitled to have his name entered in the share register under an amalgamation proposal, then he or she can be considered as a shareholder. And the third one is a person to whom a share has been transferred and whose name ought to be but has not been entered. For example, in the share market or somewhere, I bought the shares, but my name has to be entered, or has to be entered into the share register, but still it has not been entered. But in even that circumstance, during the period between that 2 points, then he can be considered as a shareholder. And finally, when notice of a trust is entered in the share register for the person for whose benefit such shares are held, then that person, he or she, can be considered as a shareholder. So these are the 4 circumstances where even though the name is not in the share register, but the particular person has to be considered as a shareholder. Okay, understand? So there are 2 things. First one is if the name is, if a person has to be considered as a shareholder, then that person's or she name has to be in the share register. That is a clear cut. Then there are 4 exemptions has been given to you. Under that also, you'll have to consider that particular person as a shareholder. Then they say that where company has wrongfully failed to enter the name of a person to whom shares have been transferred, then even that circumstances also, he or she can be considered as a shareholder. Any doubt you all wanted to ask from this? These are some clear-cut things, actually. Nothing to explain much. Then we have seen that first we have seen that what is the shareholder, and then we are going to see about the liabilities of the shareholder. Okay, if it is a shareholder, he or she may have liabilities. So when I am having the power, when I am having the I should have the liability. I should have the rights and all. This is the liability. Liability in the sense what are the it doesn't mean the responsibility. It is if in the case of companies failure or something, what would be the liability? So first thing is the liability is limited to any liability expressly provided in the article of association, the company or under the Companies Act. For a shareholder, the liability is not unlimited. It's a limited. That is the main benefit of the limited liability company. For a limited liability company, the liability is limited. So it says that how the liability is limited is based on the Companies Act or based on the article of association. What are the things? What are the things has been mentioned in the article of association? Or based on the Companies Act, his the particular person, the shareholder's liability is getting limited. The second one is he or she not liable for any act, default, or an obligation of the company only by being a shareholder. That is an important thing. For example, the company make a default or company doing some wrong things, but being just a shareholder, he or she will not be liable for that. He is not liable to any act or default or an obligation of a company only by being a shareholder. That is the second one. The third one is shareholders have the liabilities only to the extent what the act or article states. That is the first one we are saying that they have the fault. I'm reiterating, but the third point, shareholders have the right only to the extent what the act or article state. Then the liability is called, these are some definitions or these are some things mentioned in the act where the liability is for call, where a shareholder, share render is holder liable to call. The liability is to the current holder of the share, where the liability becomes the enforceable before the registration of the shares in the name of the current holder, where all or part of the consideration payable remains unsatisfied. Liability is on the person to whom the shares was transferred. So it is said that when the transitional period, when the shares has been transferred from one person to other person, so in that circumstances, what is the liability for? So these are the main things about the liability of a shareholder. Any doubt you all wanted to ask from this? Okay, then I'm going to the exercise of powers. I'm saying that okay, the shareholder has some liabilities. Again, shareholders have some powers. Okay, that powers in the sense the shareholder can exercise his or her powers. The first one is powers reserved to the shareholder by the Company Act can be exercised only at a meeting of the shareholders by a resolution in line of the meeting. Okay, as a shareholder, he or she may have the powers, but can he or she exercise at any time in the company? For example, I go buy a company or the bank X shares. I am a shareholder. Can I just enter into the branch or head office and can exercise my power? No. Actually, a shareholder can exercise his power at two circumstances. First one is at the meeting of the shareholders meeting, maybe AGM, DGM and all. The annual general meeting or special general meeting, those AGM, annual general meeting or special general meeting, at the meeting of shareholder, they can. And then other one is by passing the resolution, even in the meeting, by passing the resolution in the meeting, they can exercise the power. And powers reserved by the article be subject to the articles of be exercised at a meeting of a shareholders by resolution of lien of the meeting. And the third point, it says that resolution of lien of the meeting, it says that subject to the articles, that means article means article of association, a resolution in writing signed by not less than 85% of the shareholders who is entitled to vote at a shareholder meeting and who together hold not less than 85% of the votes entitled to be cast on their resolution is valid as if it has not been passed at the shareholder meeting. So there are some limitations. They are saying that subject to the article of association, they can exercise this power. And the exercise of the powers by resolution, we say that okay, they can, the shareholder can exercise the power by at the meeting only, shareholders meeting only, they can exercise the powers, and by passing the resolutions. So okay, the resolution, of course, there are two type of resolutions are given. First one is ordinary resolutions. The ordinary resolution means unless otherwise provided in the article or in the act, powers reserved to shareholder can be exercised by an ordinary resolution. If there is any special circumstances which required by the article of association or act, other than that, all other things can be, all other powers can be can be get by to the shareholders, can be exercised by the ordinary resolution. Ordinary resolution is enough in all circumstances, except there are some special circumstances given in the article or act. The ordinary resolution means a resolution is approved by simple majority. Just keep it in mind. The simple majority means the more than 50%. Simple majority of the votes of those shareholders entitled to vote and voting on the resolution. So, for example, if the total shareholders is 100%, the 100, everybody has a 1 each has. So, in that case, more than 51% has to vote for a particular resolution to get as an ordinary resolution. And the special resolution means a resolution passed by majority of 75% of the shareholders entitled to vote and voting on the resolution. So, these you may ask that what are the circumstances? I think in the next slide we will see that what are the circumstances a company has to apply this, pass this special resolution. In the next slides we will see. For those circumstances, they have to pass a special resolution. What is special resolution? If it is more than 75% of the shareholders who are entitled to vote and voting on the resolutions. So sometimes some shareholders may be entitled, but they may not cast their vote. They don't voting at the meeting. So we have to consider this 75% based on the voting on the resolutions. Okay, and at general meeting of which not less than 15 days, working days, notice specifying the purpose of resolution as a special one has been duly given. So if it is a special resolution, they have to give 15 working days notice specifying the purpose of resolution. So in that circumstances only, they can give the special resolution. So these are the two ways a shareholder can exercise their powers. One is passing ordinary resolution. Second one is passing the special resolution. And they say that other than some specified cases, circumstances, all other circumstances, you can pass the resolution by the ordinary majority or simple majority. The exercise powers by the special resolution, I have already mentioned, for certain cases only, special resolution is necessary. What are the things? Alter the company's article of association. approve a major transaction, approve an amalgamation of a company, reduce the company's stated capital, resolve the company to be wound up voluntarily, change the name of the company, change the status of the company. In this case, they have to pass special resolutions. And finally they say that first three can be passed only by another special resolution, and fourth five cannot be resigned. Resign means recover. So there are some exception on the special resolution. So this is about the powers of the exercising powers of the shareholders. So you can see that we have seen about the at what circumstances, and then we see the resolution, ordinary and special resolution, and then we have seen about the powers, how they can, at what circumstances they have to exercise with the special resolution. Alter the company's article, approve the major transaction and all they have mentioned. So before going to the shareholders' right, you all wanted to ask any question from me? Come on, students. Okay. There's a questions. Sir, like major corporates having major shareholders, example person, when it comes to a bank, also can the shareholder have the major shares? Actually, they simply ask that for the some corporates, they are having a major shareholder, and they have mentioned, he has mentioned a person. You can just there are persons who are having the major shareholders, and he asked the question that when it comes to the bank, also can a shareholder can be the major shares. Actually, in the Banking Act, there are some restrictions to have a shareholding. For example, if it is a general production company or retail trade company or any other service type companies, they can have any shareholder can have the shareholding up to 90% or 80% or 70% as a major shareholder. But in the bank, of course, there can't be the major shareholders, because it is the banks are running with the depositors' money. If it is the major, if we allow a person as a major shareholder, then he or she can influence the banking activity and misuse the bank. So in that case, the Banking Act and the relevant direction issued by the Central Bank of Sri Lanka restrict that a person can have maximum 10% of the shareholding in a particular bank. General rule, I am saying general rule. If you or me can invest in a particular bank, maximum 10% of the shareholding. For example, if it is HNB or commercial bank or DFCC or anywhere, I can just invest only 10% without any approval. So I can go up to 9.99%. So if you see the major shareholders list in some private banks, you all can see some most of the people are invested up to 9.99%. So maximum 10%. But there are some exceptions in the banks also. That particular direction says that, okay, by considering some interest of the particular bank, the monetary board can approval to a particular shareholder to have the shares up to 15% level. Okay, so here without approval, any particular shareholder can have the shareholding up to 10%. But with the monetary board approval, the particular shareholder can go up to 15% level. But here thing is you have to consider, but when the monetary board grant the approval for 15%, by considering the bank situation, it will impose a condition that, okay, after 5 years or 10-year period, you have to reduce this shareholding within the 10% level. So you may ask that, what are those circumstances? For example, if a bank, they have to, for example, a small bank, it has to maintain the minimum, the capital requirement of the bank. So for example, if it is the commercial bank, it has to maintain the commercial banks. It may be HNB or BOC or any bank. The commercial banks has to maintain 20 billion as a stated capital, minimum stated capital. In that case, circumstances, particular company does not meet that minimum capital requirement, but a particular shareholder is ready to invest. So, but he is already having the 10% shareholding. Then at that circumstances, the monetary board may approve to that particular shareholder, okay, you can invest in the shares up to 15%. Then, but you have to reduce in within a 10 years period or some longer period. So those are the circumstances. Monetary board will give some leeway. But there are some exceptional as well. For example, the government may have become the treasury secretary may become the largest shareholder. For example, the BOC and People's Bank, there is no any shareholder restrictions because treasury secretary having as a only shareholder. But generally, if it is a bank incorporated under the Companies Act, maximum 10% they can go. I will understand this. Are you clear? Okay. Then that is all about the shareholders, the maximum shareholding in a bank. Okay. Then we will move to the shareholders' rights. The shareholders' rights, a particular shareholder has the power and liability, as well as he has some right, he or she has some rights. But these rights are given under the Companies Act or Article of Association or prospectus. Prospectus means when they are issuing the shares, they are releasing some prospectus, then they can get that some powers or rights, some rights through these three documents: the Companies Act, Article of Association, and prospectus. Actually, the person who is getting the rights through the Companies Act is called statutory rights. Anybody can't alter the statutory act, and it is given by the act, actually, the rights. And a company shall include the shareholders' right in the company's Article of Association also. They can just generally by Article of Association, the company shareholders can have rights. And no action can be taken to affect the right attached to the shares unless approved by the special resolution. By approving the special resolution, then they can alter the Article of Association, and then through that way they can just then taken the actions affecting the rights attached to the shares. Other than that, other than special resolution, they can't alter. Understand? Then it's giving that a shareholder, what are the rights, the shareholders' rights? A shareholder is entitled to the following rights. First one is, this is to enter his name into the share register. He can say that, okay, enter my name because I am one of the shareholder in the share register, to enter into the share register. He or she has the right to check the share register. Okay, every company has to maintain the share register. So in the share register, the company has to write out all the current shareholders' name. So a shareholder has the right to enter his name or her name into the share register, and he or she has the right to check the share register and obtain copy of the share register information for his or her purpose. This is about the first one. And the second one, it says that to obtain a copy of the Article of Association of the company, he has the right to obtain the article of association of the company. And then third one, to obtain the prospect if the company wishes to issue the shares in the future. Okay, for example, company first starting and with a certain shareholders. Now the company going to, for example, it's a listed company. It's going to issue a shares. But then for that purpose, they may issue the prospects. So at that time, a shareholder can obtain the prospects, copy of the prospect, and the participate in the shareholder meeting. Actually, the shareholder has all rights to participate in the shareholder meeting because he can exercise his power through that meeting, and to vote on a poll and to demand a poll at a meeting. There are two things here. First one is, if there's a poll, he can vote. Another one is, he can demand a poll at a meeting for anything. Another thing is, finally, to appoint a representative on behalf of the shareholder to attend the meeting to vote. So he has a right to appoint anybody as a representative to him or her. By voting in a poll, then he can actually indirectly he can select the directors, he can select the auditor, and likewise he has some indirectly by voting they can have those selection powers as well. So these are the things about the shareholder rights. So under this, actually the last class we could not go through these things because of that lack of time. So we have gone through about the shareholders now. First we have seen about what is shareholder and liability of the shareholders, and then we have seen about the powers as well as resolutions. What are the resolution, ordinary and special resolution, and then we say that what are the circumstances where the special resolution has to be passed, and then shareholders' rights also we have seen. So now we are going to move into the directors of a company, the new section, which also like the shareholder, there are some requirements under the Companies Act. Before moving to that, if you all have any questions. Yeah, actually, shareholders, there's a student asking that shareholder rights slide is not available with the chart file. Of course, yesterday night I have shared that file, but after that I have made some adjustments in the shareholders' rights based on the Companies Act and some other literatures. So I'll ask the IBSL people to again share with them my new slides. That has slide only. I think these two slides are different. The slide number 9 and 10 there are some differences. I have included these two slides, so I will ask them to go through these slides. I'll ask them IBSL people to share this new presentation file with you all most probably today evening. Okay, any questions? Otherwise, I will move to the other sections, directors of a company. These slides talk about the primary duty of a director. The director has the duty. The first one is act in good faith what he or she believes to be in the interest of the company. Okay, he or she can do whatever the director can do the things, but he has to act in a good faith that it is the interest of the company. And however, in case of a director of a company which is wholly owned company of another company, may, if expressly permitted in the article, act in a manner that he or she believe in the interest of that other company, even though it may not be the interest of the company that he or she is a director. What it does mean? What it is mean? So what is the meaning of the second sentence? The second sentence says that, okay, a company director, he is a representative of other company. For example, if a company A is the parent company and company B is the subsidiary company and fully owned subsidiary company, and in that case, in the article also is permitted. So in that case, he need not to, a particular director of the company need not to take a decision based on the interest of company B. He can take the decision based on the interest of company A, parent company, because that is permitted, because that is the fully owned subsidiary company. So they have created to the benefit of the parent company. In that case, even though it is not the interest of the company B, he can exercise the interest of company A, the parent company is exercised. He believes that interest that are other company, even though it may not be interest of the company. Understand? For example, if any person as a director, he has to act in the interest of the particular company. For example, I am a director of the company X. I have to always act in the interest of the company X. But they say that sometimes I may not act in the interest of the company X, because if the company X is the fully owned subsidiary of the company Y, in that circumstances, even though I am director of the company X, I may not act on the interest of the company X. I may act on the interest of the company Y, which is the parent company of the X. Understand? So, sometimes if it is a subsidiary company director, he may act on the interest of the parent company, but it has to be fully owned subsidiary company. If there are other shareholders, of course, they have to maintain the minor shareholders' interest as well, but that's wholly owned company, if it is 100% shareholder. The third one is, a director shall not act or accrete to the company acting in a manner that contravenes the provision of the act and article of association. But a director has not been act, it is contradict to the provision of the act or article of association. That is obvious. And fourth one is, not act in a manner which it is reckless or grossly negligent. The negligent way, if he or she cannot act. And exercise degree of skill and care that may be reasonably expected of a person of his knowledge and experience. Actually, for example, if a chartered accountant appointing as a director, then he has to exercise the degree of skill. As a chartered accountant, his skills and care has to be the reasonably expected from the person based on his knowledge and experience. Okay, for example, a teacher and a chartered accountant appointed as a director of the particular company, then as a chartered accountant, we may expect high skill with respect to accounting and auditing aspect, but we won't expect that from a teacher who is also director. So exercise degree of skills and care that may be reasonably be expected of a person of his knowledge and experience. So those are the prime duty of the directors. There's a question, sir, can you explain the 2 point again? Which 2 points, sir? Can you explain the 2 point again? Which slide? Okay, I think the time is okay. Second point. Okay, I think this slide, the second point. This is the primary duty of the director. The first one, it says that act in faith of what he or she believes to be the interest of a company. For example, I'm a director of the company A. I am the director of the company A. In that circumstances, I have to act in a good faith of or believe that it is whatever the act I am doing, which is the interest of the company A. So it is good for the company A. That is the general rule. But they say that this general rule can be deviated in some circumstances. What is that circumstance is, if the company A is a fully owned subsidiary of the company B. Company B is fully owned subsidiary company A. So the company B has the 100% ownership in the company A. Okay. And at that time, if a person, a company A director, he may carry out his duties or act on the interest of company B. The interest of company B, even though he is a director of, generally if it is a director of company A, what he has to do? He or she has to act in the interest of company A. But since it's a fully owned subsidiary company, he may act to the interest of company B because that is the subsidiary. For example, we will take in this way. For example, for a selling product, they are producing some machinery items, some machinery parts. Okay, some machinery parts. So when they are selling that machinery parts, the particular director, with regard to the selling decision or anything, the particular director has to take the company A producing the machinery parts. Okay. When they are selling, the director has to take a decision on the selling that particular machinery part, he has to take the decision at the benefit of company A. That is the generally expected. Okay, when he is fixing the price or anything, he has to take the decision at the benefit of company A, because which is producing that particular parts. But now there's another circumstances. Company A, which is the fully owned subsidiary company of the company B. Actually, this company B formed this company A to do the that particular parts. That parts can be used in the parts can be used for the company B's main machine. For the main machinery, he can use this particular part from the company A, which is the fully subsidiary company. In these circumstances, we say that, for example, this particular parts, other companies are asking, other purchasers are asking for 100 rupees or 1 million rupees. But this parent company asking only 900,000 rupees. 90,000 rupees, sorry. 100,000 rupees other purchasers asking, this parent company asking only 90,000 rupees. Even though the good act, in the good interest of the particular company A, the particular director has to give the machinery or particular parts to the outsider because he is asking higher price. But rather than giving that machinery, he can ask the people to give it to the parent company, which is the interest of the parent company, because that is the fully owned subsidiary of the company B. Did you get the point? Or you all have confused it? Okay. Yes, sir. Okay. Yeah, that's the thing. If you'll have any doubt, don't have any hesitation. You can ask the questions. I'm again and again. I'm ready to explain because that is my duty. That's what I am taking the classes. So if you need any things to be clarified, you can just ask from me. Thanks for questions. Okay, then use of information. Okay, then I'm moving to the use of information and advice. Actually, a director take the decision based on the information and advice obtaining from other people. Okay, for example, if it is our central bank monetary board, the monetary board members are taking the decision based on the information or analysis we provide to them. Likewise, if a company, if a bank's board of directors, they can take the decision based on the information and advice given to the particular directors. It may be insider or it may be outsider. If a director acts in a good faith, make proper inquiry and has no knowledge than reliance on the certain information is unwarranted, he or she can rely on the information and advice of others. They say that in order to add a good faith and and make proper inquiry and has no knowledge and the reliance on the certain information is unwarranted, he or she can rely on the information and advice of others, other people. The information and advice rely panna mudiyum. Sorry. I just mixed my language. Sorry. So he or she can rely on the information of advice of others. The second one is a director may rely on reports, statements, and financial data and other information prepared or supplied and on professional or expert advice given by the following person. So the particular director can use the information from the expert knowledge and expert advice and professional advice from the following person. Particularly, it may be an employee. Second one is a professional advisor or expert that the director believed to be competent. So the director has to believe that that particular person is a competent person. So give the particular person is competent and can give the professional advice. And third one is any other director or committee of the directors in which the director did not serve, to which the committee is authorized. So in this, from following persons, they can get the information and expertise advice and act as a good faith of in a good faith of particular company. So this is sort of information. This is explaining the circumstances where a director can use the outsiders, other people information and advice. Then this slide is talking about the director interested transaction. Before that, okay, there is no questions. Okay, there are some transactions which may be interested to the particular director of the company. Director interested transaction. For example, it says that a director of a company is interested in a transaction to which the company is the party and a director. They are saying that those are these points are describe what are those circumstances. For example, the company may carry out several transactions. Several transactions in the sense it may be purchases or it may be some other service providing service. They are maybe providing services or any other circumstances. But in that circumstances, sometime one of the director may become the related party, interested. They may have the interest on the particular transaction. For example, a bank purchases software from a particular company where the bank director is the director of the particular company. Then the particular director may have the interest on that transaction, because if that deal is happened in smoothly, then he can get some benefit from other company as well, that software providing company as well. So that is director interested transaction. Director is the common person for other things. So these are the circumstances they have just said that. First one is director is a party or will or may derive a material financial benefit from the transaction. So first one is in the particular transaction, director is one of the party, or will or may derive a material financial benefit from that particular transaction. In that case, that transaction can be considered as a director interested transaction. For example, as I mentioned, the bank X which purchased some software from a company A, where the company A is in the company A, one of the director is the director, and he is the major shareholder in the company A, the software company. So when the bank X purchased the particular software from the company A, then the particular director may get the financial benefit. So he is a party. So in that case, circumstances, director interested transaction, it's considered as a director interested transaction. Generally, we are in the accounting term, those who have studied the accounts, they may know the related party transactions. This is more or less similar. The second one is a director has a material financial interest in another party to the transaction. That is also in the other party of the transaction, he has a material interest, financial interest. And is a director, officer or trustee of the other party to a person who will or may derive material financial benefit from the transaction. In the other party, the counterparty, where the director maybe is a director, officer or trustee of another party, then that may be considered as a director related interested transaction. It's a parent or child or spouse of another party to a person who will or may derive a material financial benefit from the transaction. For example, I am the CEO of the bank. I ordered a software, or I just granted loans and advances to a company where my spouse is the CEO, or my spouse is the financial officer or chief accountant of that particular company. So in that circumstances, if that deal is happened, that company will get benefited. So that type of transaction would be considered as a director interested transaction. The parent, child or spouse of another party or person who will or may derive a material financial benefit from the transaction. The director is otherwise directly or indirectly materially interested in the transaction. These are called director interested transactions. Understand why we are saying this director interested transaction? There are some other condition on this. These type of such transaction should be entered in the interest register. Understand? I think in the beginning of this class, I have explained to you about the interest register. I say that if there is any transaction happen between the shareholder or director, the shareholder and the company, those should be recorded in the interest register. On top of that, if there are some director interested transaction, such transaction should be entered in the interest register. What are those director interest transactions? These are the director interest transactions. Understand? Okay. Then that should be disclosed to the board. If there are any direct interest transaction, particular director should disclose that information to the board. Sometimes if it is a good corporate governance prevail in particular company, they may take the decision without that particular director. For example, again I am taking the same example. Company X or the bank X buy a software from the particular company A. That company A, the one of the bank director is the main shareholder or director of the particular company A as well. At that time, he or she, the bank director, has to disclose that, look, I am the director of the particular company also. Sometimes the board says that, okay, we are going to take the decision on that purchase of software. So since you are the director interested person, just prevent from involving in the decision making process of particular particular purchase. So this may happen in the, it is not requirement in the good if there's a good corporate governance in the particular company, they may take such a decision. To take the decision, actually what they have to do is particular director should disclose to the board, look, I am having the interest on this particular transaction. This is director interested transaction. And these director interest transactions should be disclosed in the annual report as required. That's what I always say. I have already informed you, told you that if those who are studied in the accounting and audit may know that in the annual report, there's the notes to accounts. There are several notes to accounts. One of the notes is related party transaction. The related party transaction is more or less this director interested transaction. So this has to be disclosed in the annual report as required. And failure to disclose will not affect the validity of the transaction. It says that, but it's a failure to a disclosure will not affect the validity of the transaction. But it is good to disclose. However, a director who failed to comply with the requirement act shall be guilty of an offense and liable for punishment. Okay. Then the failure to disclose will not be affect the validity of the transaction. However, the particular director will be fined as a guilty of offense. Understand? Okay. Any before I think okay. Use of company information. I think this is also related to the directors. So before that, do you have any questions on this which we have discussed? Okay, then there is this slides is discuss about the use of company information, because there are several informations that a director may get in when he is carrying out his or perform his duty as a director. A director who has informed as a director or employee of the company which would not otherwise be available shall not disclose that information to any person or make use of or act on except, okay. But it says that a director of the company or officer of the company, employee of the company may get more information which is not available to the public or which is not otherwise available. For example, there are some decision makers, okay, company directors have decided, okay, they are going to issue the right issue. They are going for a right issue, or they are going for a bonus, share split. They have decided. But that information, since as a director, he got that information. But otherwise, if that information is not available for general public or any other people. So in that circumstances, he or she, the particular director, should not make use of that information for the personal benefit. But he can use that information so following circumstances. And he should not disclose. For example, the company has or particular bank going to split their shares. So he should not disclose to anybody, or he should not use for his own benefits. Okay, he should not tell to the friends and all. Okay, this company and this bank going to split the shares. Macham, buy this shares, then you will get more benefit, or you will get more financial benefits. They can't disclose those information, but they say that they can disclose those kind of secret information, in the sense the company information, the following purposes. For the purpose of the company, if it is for the purpose of using the company, they can use that information as required by the law, where the article of association authorizes, where the board authorizes the director, such authorization is entered the interest register, then they can disclose that information. Otherwise, they can't. Simply, this is a secrecy provision. A director may come across several information of the company. He or she should not disclose. Otherwise, it is related to the company or authorized by the law. Understand? Then appointment. One minute. Yeah, sorry for the delay. Sorry for the interruption. So then this is this slide about the appointment and removal of directors. The first one is a public company should have at least 2 directors. So that is everybody, most of you all know that if it is a public company, they should have the 2 directors. Otherwise, at least 1 director. At least 1 director there should be, if it is not a public company. There are some disqualifications to become a director. First one is, if the particular director, he or particular person's age is less than 18, then he or she cannot become the director. And undischarged insolvents, he has declared as an insolvent, then he or she cannot become the director. Insolvent, what is the meaning of insolvent? I think it is not famous in the in Sri Lanka, but it's famous in the foreign countries. The people are saying that I am bankrupted. I can't meet my debt obligations. They declared as an insolvent person or bankrupt person. So in that circumstances, a particular person cannot discharge the duty. Sorry, become the director of the particular company. And who is prohibited from being a director? There are some circumstances, regulators may or some others may say that the particular person cannot become the director of the particular company. For example, if it is the, you may study that the subsequently later part of this session, not today's one, may in the coming sessions, one of the requirement when appoint a director in the bank, they have to send that, they have to get a fit and proper test from the central bank, clearance from the central bank. But some certain directors name central bank prohibited, saying that you can't appoint the particular person as a director, because they may, or the particular person or he or she may get involved some illegal activity or some fraud in other companies or other financial institutions. So that person has been listed as a blacklisted person. So in that case, so who is prohibited from being a director? Again, the unsound mind. Unsound mind, you all know that it's okay, and not a natural person. Natural person in the sense the company cannot be a director of other company. So the natural person has to be a director. Actually, company can be considered as a artificial person and does not qualify as per the article of a particular company. So in that circumstances, a director cannot be considered as a person cannot be become a director of a company. And to become the director of the company, there are several requirements given in the Act. A director should give his consent to appoint in the prescribed form and certify that he is not disqualified being the appointing or holding the office. These are actually, these next three slides are particularly in the Act. There are nothing too much explained. Just keep it in mind. The first one is, what are the requirements? A director should give his consent to appoint as a director in the prescribed form and certify that he is not disqualified from being the appointed as a director. That is the first one. The retiring age in the public company or private company that is subsidiary of a public company is 70. So he or she has to be below 70 unless if there is any special approval. However, can be reappointed upon the passing a resolution at a general meeting for a 1-year period. Okay. And director has the duty to disclose his age when he attained 70 or any other lower age specified in the article. If it is an article in specify that a particular company can, the director can be, or a person can be a director in a particular company up to 65, then when he reached the 65, he has to mention that 65 because the article of association particularly mentioned that 65 as a retirement age, but otherwise it's a 70. Board proceedings are governed by the article of association, and remuneration and other benefit decided by the board as an article permitted or by ordinary resolution. These are some of the requirements related to the Companies Act. Just keep in mind. Another requirement, the granting loans to a director should be in accordance to the provision of the Act. And if expressly authorized in the article, a company can be indemnify a director for any cost incurred by him in the proceeding that relate to liability for any act or omission in his capacity as a director in which judgment is given in his favor or in which he or she is acquitted, discontinued or granted relief. In that circumstances, the company can be act accordingly. And a director who believes that the company is unable to pay its debt as they fall due should call a board meeting to consider whether the company should be applied to the court for winding up and appoint a liquidator or administrator. This is an important thing you have to keep in mind. There were some questions in the past papers. But it is meaning is a director, he believes that a particular company is unable to pay its debt as they fall in due. Particular director should call the meeting to consider whether the company should be applied for a winding up or appoint a liquidator or an administrator. For example, because this is the situation, insolvent situation. Company enter into the insolvency, sign of insolvency. So if a director believes that the company enter into the insolvency situation, he has to call for a board meeting and apply or to ask them to request them to consider whether to wind up the company or liquidator or administrator. That is one of the duty of the director. If at any time it appears that the net assets of the company are less than the half of its stated capital, the board should within 20 working days call an extraordinary general meeting with due advice and information. So particularly specifically say that at any time the net asset value of the company, net assets of the company are less than half of its stated capital, then and that circumstance within 20 days, they can call for extraordinary meeting and due advice and information to the shareholders. Before moving to the stated capital, I think I have just read these sections because these are in the act and it's very straightforward things. If you all have any questions or if you all wanted to clarify anything, you all can ask from me. Otherwise, I will move to the other sections. Okay, then I'll move into the stated capital. We have mentioned that if at any time it appears that net asset of a company are less than the half of its stated capital, the board should within 20 working days call an extraordinary general meeting, due advice and information. Here, of course, somebody may ask that what is stated capital? These slides discuss about it. The total of all amount received by the company or due and payable to the company in respect of issue of shares and in respect of call on shares is called stated capital. So where shares are issued for consideration other than cash, the board will decide the cash value of such item. For example, if generally the shares are issued for the consideration of cash, but sometimes if the company, if the shares are issued other than cash, then the board of directors has to decide the cash value of such shares. Stated capital can be reduced by special resolution, and there is a special. We have already discussed what is special resolution. And public notice should be given before 60 days of passing such resolution. If it is the reduce the special stated capital, then they have to give 60 days before that public notice has to be given. I think these are very straightforward things. And then we have seen about the solvency. If a director feel that it is in a company is become the insolvent, then they have to call for a board meeting and have to appoint the liquidator. So here in the slides we are discussing about what is solvency test. The board is required to satisfy the solvency test and obtain a certificate of solvency from the auditor before any dividend is distributed. This is one of the requirements. It means before issuing the dividends, they have to obtain the certificate from the auditors, solvency certificate from the auditors. The company is solvent. Solvency test is satisfied if a company is able to pay its debt as they become due in normal course of business, and value of the company assets is greater than value of the liability and company stated capital. Okay, so solvency test is generally there were questions in the past papers which asking about the solvency test or solvency versus liquidity, solvency risk versus liquidity risk, which we will discuss in the risk management section. But at that time we will discuss the solvency is sort of long-term concept, where the present value of the assets are not enough to or are less than the present value of the liabilities, then that particular company become insolvent. But in the Companies Act, it says that this is, I'm saying that the accounting term, but in the Companies Act, it says that the value of the assets is greater than the value of the liabilities. So so a company's solvency when the assets is higher, liabilities lower. But if it is other way around, the company become insolvent. The assets is less, the liability is high. And the asset is less than the company's stated capital, then in that case, company become insolvent. So actually the companies has to take the solvency test before declare the dividend. So in the from whom they have to take the solvency test? From auditors. They have to take the solvency test from the auditors. Then they will test whether the assets are higher, greater than the liabilities and stated capital. This is about the solvency test. The board should consider the following determining the satisfaction of the solvency test. The most recent financial statement prepared in accordance with the Companies Act section 151, true and fair view of the state of affairs as the balance sheet date, and the profit and loss or income and expenditure for the period of the balance sheet date. Circumstances that directors are aware or ought to know which affect the value of the company's assets and liabilities. A fair value or other method of assessing the value of the assets and liabilities. So when they are doing the solvency, they have to consider these things. I think we are having 2 more slides in related to the Act matters. So once we finish the Act, then we will move to the other sections called licensing and all, which is so something comparably more interest than this Act matters. There are some, I say that there are some statutory books and registers which has to be maintained by the company. The first one is minutes book. There were no questions about this related to this, but you may just keep it in your knowledge. First one is minutes book for recording proceeding of general and board meetings. They are maintaining, companies maintaining minutes book. Attendance book for recording attendance at company and board meetings. Index of shareholders, when the number of shareholders exceed the 50, they have to maintain index of shareholders. Share register, which already we have discussed, as register recording the shares issued by the company and the name and the last known address of such shareholders and the number of shares of each class held by during the last 10 years, and should also include the date of any issue, repurchase or redemption of shares from or transfer of shares by to the such shareholders. So all these shares related things have to be registered in the share register. And the register of the directors and secretaries, the register of the director and secretaries contain their names, residential address and business occupation. If the secretary is corporate body, its names and registered and principal office. An interest register, which we have already discussed, and register to record any transaction or proposed transaction with company in which director is interested, as well as any transaction between the shareholder and company has to be registered in the interest register. These are about the Companies Act matters. You will have any questions you can ask. Actually, we have in today's class we have first discussed about the shareholders' rights and powers and all. Then we have discussed about the director of the company, their prime duty we have discussed, and how can they use the information and advice, and then direct the interested transaction, which is something important things, which is related to the related party transaction concept. And then we have said that how they have it has to be treated, and the use of company information and which circumstances they can disclose, and generally they should not disclose that to the outsiders, and appointment of the directors and other requirements, as well as stated capital, solvency test, and then some books and register which are maintained by the companies. So these about the act, and these about the Companies Act with related to the incorporation of a finance institution or company. So we are going to move into the licensing part. Before moving to that, if you will have any question, you will can ask from me. Any questions you all can ask. Otherwise, students, what normally what I am doing is, if you all are not asking the questions, I try to answer some ask some questions from you all to just keep the class wake up, because it has to be in a sort of discussion way, both side conversation. Then only it will be interested. If you all have any question, you all can ask. Don't hesitate anything. You can. Some students are thinking that am I asking a silly question or something, and what others think. Don't think anything about it. If you all have any doubt or any questions, you all can ask. But these are very straightforward things. These are in the act, of course. Actually, even if you will ask something related to the act, actually, I have to refer the act and as to answer you all. But if you will have any doubt, you all can ask the questions. Okay, I'm asking a question from you all just to check whether you all are alive. When a company converted from private companies to public company, okay, when a company earlier registered as a private company, it has been converted to the public company. In these circumstances, by the resolution or anonymous resolution, they avoid to maintain interest registered in the earlier circumstances. Okay. Now I am asking the question from you all, whether they can continue that practice. That practice means not maintaining interest register even after converting to the public company, or it is compulsory to maintain the interest register in a particular public company. Yes or no? If I am simply asked the question, whether a particular public company compulsorily maintain interest register or not. Come on, students. You understand the question. The question is, if it is the public company, whether they have to maintain interest register or not. Whether it is compulsory, maintaining the interest register is compulsory for a public company or not. What is the answer? You can just tell directly, or otherwise what you can do is you can yeah, that is the answer. Yes, it must. Since now public company or public also own the share. That is the answer. Yesterday, I think the last class I have discussed this matter. If a company converted to the public company, they must maintain the register, interest register. But if it's a private company, they can just passing the anonymous resolution, they can avoid to maintain. But if it is a public company, by statute, by act, it's compulsory. Okay. Thank you for the answer. Actually, these answers are giving some feedback to me whether you are alive and you are following my classes or something. That's a way. That's a reason I am asking the questions. Not anything else. Okay. If you all don't have any other questions, I can just move into the next section. Major financial institutions in Sri Lanka. The financial institution which we have discussed in the last class as well. I have listed out major financial institutions. If you have read the annual report of the Central Bank of Sri Lanka, the annual report every year, annual report is published by the Central Bank of Sri Lanka every year. At the generally in the March of April, because by statute they have to hand it over the annual report to the finance minister before 31st April of the particular year. So generally, Central Bank prepared and publishing it. And in the annual report, there's a chapter called Chapter 8, Financial System and Stability. In the Financial System and Stability chapter, it discusses about the development and performance of the major financial institutions. If you read about that chapter, you will may get the idea about the major financial institution and what is the position or the condition of those things, development and risk. Okay. Then in that case, this is the table I got it from the chapter 8, where we are just listed out all the. Actually, our department is preparing this chapter 8, where we are listing out all the major financial institutions. The first one is the central bank. I say to you all, even though central bank is considered as a regulator, it can be considered as a financial institution as well. So, Central Bank of Sri Lanka, licensed commercial bank, licensed specialized bank, and these are the banking sector. And other deposit-taking finance institutions, all the institutions cannot be take the deposit, cannot accept the deposit from the general public. Only certain institutions. Main institutions are commercial banks and specialized banks. And other than that, licensed finance companies and cooperative rural banks and theft and credit cooperative societies can be accept the deposit from the general public. So only these 5 institutions, and generally the central bank don't accept the deposit from the general public. So only these 5 institutions can accept the deposit from the general public. Licensed commercial bank, licensed specialized bank, licensed finance companies, cooperative rural bank, and credit cooperative society. These are the main institutions. You may ask that Samurti Bank, of course, Samurti Bank, but that are considered as a semi-regulated institution, not the main regulated institutions. So these are the main banks, main institutions. Other than that, there are some financial institutions which involving in the financial activities, but they can't accept the deposits. First one is the leasing companies, specialized leasing companies, and primary dealer companies, stockbrokers, unit trust management companies, major intermediaries, market intermediaries, and venture capital companies. These are the companies which also involving in the financial related activities, but they can't accept the deposit from the general public, because central bank and other regulators, mainly central bank, which is more vigilant about the or more stringent about the deposit taking finance institutions. because they are accepting the deposit from the general public. Okay, so these are the, and the contractual serving institution. There are some other institutions which are having contractual serving institution, called as contractual serving institution, where insurance companies, employees provident fund, employees trust fund, approved pension fund, and public service provident fund, all sort of superannuation funds are coming under these sections. So under this, we are just listing out their asset sides as well as the market share. If you see this table, you can see that this the banking sector having the last market share, 71% of the total financial system. Out of that, commercial bank, licensed commercial bank having 54.3% of the market share out of the total financial system. And other than that, the commercial banks, then central bank 9.5, and then specialized bank 7 point, and leasing and the licensed finance company 7%. All other things are less than that. But there's a second largest institution other than the single largest institution is Employees Provident Fund, which represent nearly 12.6% of the total financial sector assets. So if somebody asks the questions, list out the financial institutions, major financial institutions, or for your knowledge, since you are studying the banking studies, you will have to know that these are the institutions called about the major financial institutions. So in the coming sections, subsequent section, we are going to discuss about that how these institutions are getting licensed and what sort of business they are doing. Okay. Before going to that, you will have any questions? Okay, there are, I have already explained to you, there are 4 regulators in Sri Lanka. Who are the 4 regulators? Central Bank of Sri Lanka, and
the stock exchange, securities and exchange,
Security Exchange Commission, and the Insurance Regulatory Commission, and Cooperative Development. Do you have any questions on that?
No, sir.
Okay. So these are the 4 regulators. Mainly, there are 4 regulators. First one is Central Bank of Sri Lanka, and SEC, Securities and Exchange Commission of Sri Lanka, and Insurance Regulatory Commission of Sri Lanka, and Cooperative Development Department. Of course, most of the people may not know this Cooperative Development Department is one of the regulators. Actually, they are the people regulating the rural banks. If you see that, rural banks representing nearly 0.8%, cooperative rural banks representing 0.8% of the total finance system. Under the central bank, there are several institutions are coming under their regulations. First one is licensed banks. Licensed banks having 2 main components. What are those? Licensed commercial banks and licensed specialized banks. And other one is licensed finance companies and leasing companies, specialized leasing companies, and primary dealers, government securities primary dealers, and payment service providers. Payment service providers under the payment and settlement, Lanka Clear and all are coming under that. And on top of that, actually, this is very initial stage, but this microfinance company is also coming under the, currently coming under the central bank, but there are some discussions going on to pass it some other, but it's currently coming under the central bank. And then the Securities and Exchange Commission, which regulates near the mostly the market related, financial market related financial institutions. The first one is stockbrokers, unit trust companies, and investment companies, and margin providers, underwriters. They are coming under the Securities and Exchange Commission regulations. And Insurance Regulatory Commission, of course, all the insurance companies are coming under the purview of the Insurance Regulatory Commissions. And there are insurance companies. There are two type of insurance companies are there: life insurance companies and general insurance companies. Both are coming under the Insurance Regulatory Commission. And Cooperative Development Department, Cooperative Rural Bank, and Theft and Credit Cooperative Societies are coming under the this Cooperative Development Department. So if you actually there was a time, the one time there was a question for 2 marks question, list out the financial regulators. So at that time you have to mention these 4 names. That's enough. And licensed commercial banks and licensed specialized bank. The licensing of the banks, this licensed commercial bank and licensed specialized banks are given license or provided by the central bank. License are provided by the central bank under the Banking Act number 30 of 1988, amended several times. Now the central bank has initiated to to bring the new act for the banking business, but it is in the discussion stage. I think it may take some time, but now currently the relevant act number is number 30 of 1988. The business of a commercial bank or specialized bank can be carried out only with the authority of license issued by the monetary board with the approval of the particular minister. Actually, when a bank, when a person or a company wanted to engage with the banking business, there are licensing procedures. Under the licensing procedure, once they apply the licensing procedure, and there are several procedures, and finally, end of the procedure, if the monetary board satisfy that, then it can issue the license to particular person or particular company, not person, actually particular company, to carry out the banking business with the with the approval of the finance minister or minister in charge to the central bank. The licensing procedure has the 4 procedure. First one is submission of duly completed application. The second one is assessment of the suitability of the application. We will discuss this later in detailed manner. And issue the letter of provisional approval and issuance of the banking license. So if the licensing procedures has the 4 components: submission of the application, assessment of the application, issue of the provisional approval, and after 1 year of the provisional approval, they will issue the banking license. Then only the bank can start their business. The submission of the application, of course, I think I'm going to stop the class with this point, and we will see the balance things in the next class. So today, because if I started to the procedures and all, there are a number of slides. I think I can't finish it. So I'll stop this class with this point, and I will take it to the next class. So we will start from the licensing of commercial banks and licensing specialized bank from the next class. If you will have any doubt, today's class or the last class, you can ask. Otherwise, I will just wind up the class. Any doubt? Because licensing part is something the sort of significant section, so better it's starting and one stretch. If we discuss only, that may easy for you all to understand. Okay, if you all don't have any questions, I'll stop the class with this, and we will the next class we will continue the there's this licensing procedure. We will discuss about the banking sector license as well as finance companies and all other procedures. Thank you so much.